Episode 523 of the Trading Justice podcast. This is going to be our part 3 of the dollar, where Matt has walked us through this journey through time and history, time back machine, learned about little tidbits about that. Part 3 is going to be all about current events, right?
Mm-hmm.
We're gonna walk up from the 21st century, some of the things leading up to when we're recording this podcast on April 16th, 2023, and then some of the ramifications moving forward. I know Mike Harnett, man, I was reading him today, and he called for the fourth big bear cycle in the dollar. No, bear cycle doesn't mean the end of the dollar, right? I'm curious to get your take on all kinds of things. Before that, we're going to do a little earnings preview. And Matt, I am coming to you without a beanie today because I was meeting with respectable people.
Got to put that white collar shirt on, and
that would not have appreciated a beanie on a Sunday brunch.
No, they would. No, they probably wouldn't have. It is amazing. I did not go to said brunch, so I am rocking my hat here today.
So beaningless. So I feel it's like my Linus blanket, right? Linus blanket.
But I think I might have to comb my hair for next week's podcast.
But my second Peanuts analogy, Matt, is the last 6 months. You know how Lucy would take the ball away from Charlie, right? Mm-hmm. Like, this is what it's been for 6 months. And we've had a nice consolidation pattern, right? Bulls have a stretch, Bears have a stretch, and roughly in the same range for 6 straight months, as we head into earnings season. And, we can talk macro couple weeks from now, we can talk recession a couple weeks from now, but it's going to be all eyes on earnings for the next couple of weeks, isn't it?
Yeah, it is. This is the time where the market really starts to focusing on the corporate side of the equation. Obviously, over the last few weeks, with a buildup into this moment, with specifically the banks coming out and reporting their earnings, but there's been a lot of geopolitical conversations, obviously, with what China's doing and the conversation we've been having over the last couple of weeks. But you've also had a lot of conversations over the central bank, inflation, economic reports. It's been that landscape. But what breaks the market out of that funk, and I'm not even sure that's what it is, but what breaks it out of that mentality is earnings season, because there's not a more important moment for a company. And I don't care what conversation we're having, whether it's geopolitical, economic, or fundamental. There's not any moment in a company's history that's more important for the investor class than when they report on what they actually did. What did they do for the quarter? What EPS did they do? Did it beat the expectation? Where did revenue come in at? What does their forward-looking guidance come in? What is the conversations happening from the CMO to the CEO? What are they talking about the future? It's obviously the most important moment for an individual component, whereas a lot of the conversations we actually have as market participants is about those bigger picture conversations, right? But not in this environment. It's all about earnings. And for the next 3.5, 4 weeks, that's where the bulk of the conversation is going to be. It doesn't mean we're going to discount economic reports, but I'm also not going to really care about the Empire State Manufacturing Index this week when we're dealing with regional banks, Goldman Sachs, Bank of America, Netflix, all reporting earnings this week. And so it's going to be an earnings landscape. It's going to be an earnings conversation. And if this market wants to pick up some steam from here, if the market does want a catalyst from here, either to, break out of the short-term technical ranges the market's been in, it's to me, it's going to be on the backs of earnings here, because
the bulls really lack a theme. I would argue, and I think you would too, for 6 months, they've been winning. It might not feel like it.
Yeah.
Because we're not at like ridiculous highs, and there's been periods of sell-offs.
The what it could have been, they've won versus the what it could have been.
I mean, I think any reasonable bull would, if you asked him 6 months ago, would you take 41.50 on
every single bull would have said yes.
Yeah, you'd be like, yeah, I'll take that. And they,
what were we talking about? Half the market.
Technically, we're talking about the same things today.
Well, true. We've rotated the conversations. There's no doubt about that. But that's what we do is in the market. We recycle conversations. But 6 months ago, if you're speaking to the bulls are thinking about 3,000 in the S&P 500. They're fearing 3,000. there's not a lot of that fear in the market right this very second. So yeah, 6 months ago, if you were going to tell the bulls that they'd be fighting up against a resistance going into the second quarter, and the Fed hasn't even necessarily ended the rate cycle hiking part of the conversation, yeah, I think the bulls would take that as a win, and the bears would cry in their milk.
Yeah, the bulls really need a theme. I mean, one of the things, and and I've been tactically bullish. I'm kind of going to away from that as we enter this week. Is and once again, you're 5-6% higher, right? And you still don't have it. I mean, the lack of negatives can only take you so far, right? Well, we don't have a recession yet. Well, maybe the Fed will cut. Well, the banking crisis, nothing's important, right? I mean, there's at some point you need something to excite rather than the absence of fear.
Listen,
right?
Lack of worst case scenarios is not good enough to get the market to punch up in some degree of consistency.
That's not going to take you to all-time highs.
No, it's good enough to get you to get back into resistance. It's good enough to, because what happened, remember before the banking saga occurred, we were at these levels. We were at that 41.50 level. SVB comes out March 10th, March 11th, about a little bit more than a month ago now. And all of a sudden the market tanks a little bit. It's recovered that. And that does make sense, right? It does make sense that it's recovered that price because the worst case scenarios did not play out with SVB, at least in the short term. And so, yeah, it makes sense to recover the price, but does it make sense to break out of a very, very, very rock solid resistance level that has multiple time frame, that is a multiple time frame type conversation, which would be daily charts, i.e. the swing traders are tracking that, weekly charts, i.e. the investors and position traders are tracking that, investor camp, monthly charts. Every chart aligns with that 4150, 4200 breakout zone. And so is the lack of the worst case scenarios playing out, is that enough to create some consistency in the market? And the answer for me, being a top-down analyst like you are, the answer would be no. You have to have something else. And so when you're looking at the landscape coming up in the next week, say 2 weeks, you look at the economic landscape, for example, and this week we're going to be dealing with, this week we get, let me just go to Forex Factory real quick.
I can tell you, I've done my Sunday night prep. We got housing starts and permits on Tuesday. Empire State on Monday, Philly Fed Index existing. I mean, not much. PMI composite flash, maybe the big one, April 21st.
Friday, right? Friday with
and that's from Friday.
Yeah, those and we're not going to get a tremendous amount of earnings reports on Friday. So on Friday, you get flash manufacturing PMI, you get services PMI. Those PMI numbers are taking on greater importance as the conversation is shifting from the central bank, from certain geopolitical conversations to the economic landscape and whether or not we're going to have that recession, how deep is the recession going to be, that type of conversation. So they have certainly taken on a greater importance over the last couple months versus the last couple of years, quite frankly. But even that would not be enough for me to be like, oh yeah, that's a catalyst, right? No, it's a intraday move that could create. It's not a sustainable type theme. But what you have with earnings is you have the ability to create not just a theme for an industry, a sector, but you have the ability to create a theme for the market itself, because where we're at from an earnings perspective right now is we're kind of getting ready for what's coming at us, right? And when you're looking at that, you're trying to get an understanding of the landscape that we're looking at as well. And so from an overall macro perspective right now, we got 30 companies in the S&P 500 reporting earnings so far. Of those 30 companies, most of the bigger ones have been on the bank side, but you also had Delta Airlines, you had United Health as well. When you're looking at that macro conversation from an earnings perspective, 90% of the companies so far, now we're very early, it's only 30 companies so far, but of those 30 companies, 90% are beating the EPS handle right now. I think it's 63% right now are beating the revenue expectation. And very, very important, and this is something I talk about religiously throughout all of earnings season, is that number called the blended earnings growth number. Now, this blended earnings growth number kind of gives you the expectation for the entire marketplace. Are we excited for the earnings season coming up? Are the expectations really, really elevated? Are we a little bit cautious and we're a little bit on pins and needles, sitting on a little bit of a thin ice? That blended growth numbers kind of sets the stage a little bit. And right now, Mark, to start earnings, we're starting off at a negative 6.5% right now. And so as the expectation,
boy, they love setting low bars,
they
right?
do.
Like, listen,
They're very good at it. They're very good.
It's like the bulls, they set up to run the 100-meter hurdles, right? And the bars are at their ankles. Let's jump over these bars.
Let's go running. Set the bar low. Let's go. Let's run a dash here.
But I say it all the time, bears have to be dead right. And bulls just have to be bulls.
They do, but I mean, the thing about the bears, when they are right, they're really, really right, because volatility can ensue pretty quickly. But for the most part, yeah, these rules are all created for the bulls, and a lot of those rules are based on these expectations that occur. And oftentimes going into earnings season, the entire Wall Street world, the investor community, market participants, they will all downgrade their expectations going into earnings season. And right now you're downgraded by about negative 6.5%. That is, last quarter was a big downgrade versus expectation. This one's even more so. Now, the question ultimately is going to be, if that's the standard, we're starting off at a negative 6.5% earnings growth perspective. If the market's going to improve from here, that number most likely has to improve. You're not going to sustain the 90% beats, Mark. That's not going to happen. But you're most likely going to come in last 73%.
What was it last? It was somewhere in the 70, high 60, 70 range.
Ended up in the low 70s, and revenue ended up in the mid 60s. And right now
that's really low for
the last 5 years.
For the last several years, right?
For the last 5 years, but over the last 10 years, it's about on average. And so EPS numbers will certainly come down. 90%, that's not going to happen. A lot of expectations were very low for the banks. Banks came in with some really, really good earnings reports. And so these numbers are a little bit skewed based on what the banks did. And so I fully expect that EPS number to come down, and probably come down into that if it ends up in the mid 70s, we had a really good earnings report season. If it ends up in the low 70s, that's probably where we probably expect EPS beats to kind of end up, is in the low 70s. Revenue beats probably slightly improve from here. Right now we got 63%. They probably improve up into the 66, 67%. But again, that's all just very early on. Keep an eye on that blended growth rate. Now, Mark, the question is ultimately, can it stave off 2 consecutive quarters of declining year-over-year earnings? Because again, we did get that last quarter coming in at a negative. And the ultimate ability for the market to break out of this level that we're talking about probably has something to do with whether or not this blended growth rate improves from the negative 6.5% it is today to maybe into that negative 2%. I'd be a little surprised if we got to a growth number that's better than zero. I'd be a little surprised. When you're looking at averages here, over the last 5 years, the average earnings beat has been about 6.7%. And so if we just do the average over the last 5 to 10 years, you do come in at that zero growth, and versus a negative 6.5% expectation. That's really good. That's really good. But that's if you come in over the last 5 to 10 years. If you come in matching over the last 3 quarters, though, with when we're dealing with this monetary environment, and we're dealing with this economic environment, and we're dealing with inflation, and we're dealing with all the geopolitical nonsense recently, well, the expectations have to come down a little bit, because over the last 3 quarters, we've only seen the average beats right about 2% mark. And so if we kind of match what we did over the last 3 quarters, we still come in at a negative 4%. If we do what we did over the last 5 years, we come in right around break even. And if you take into account the 30 companies that have reported so far, that's coming in at an average beat of 7.9%. So you have to look at earnings in general, as it's been a really good start so far. It has. It's been a really good start so far. 90% EPS beat so far. 63 on the revenue side. The average beats on earnings we're seeing is about 7.9%, which is better than the last 3 quarters. It's better than the last 5 years. But again, the context around those names that you knew the expectations were really dire and they set that bar really low was on the banks. Wells Fargo, Citibank, BlackRock, JP Morgan, all had extremely low expectations and all came through really, really, really good on Friday of this previous week. And so the numbers are skewed a little bit, but it's been a good start to earnings. We got a lot of road to travel on this conversation, but so far so good from an earnings landscape perspective. But we just started off, Mark, and I can't say that enough. We just started off. These numbers always change quite dramatically, not necessarily this week, because when you're looking at the landscape this week from just, once again, a specific conversation over the types of names that are reporting this week, when you are looking at the landscape, and I'm just going to go to FinViz to kind of look at this week coming at us, that from an overall reporting standpoint, and when you're looking at the names this week, you're talking about Tesla, Taiwan Semiconductor, Johnson & Johnson, Bank of America, Abbott Labs, Philip Morris, and Netflix. And keep an eye on Netflix. Tesla's probably the most important company reporting this week. It's by far the biggest company reporting this week. Keep an eye on Taiwan Semiconductor. That's going to be really important for the semiconductor space. But Netflix has been one of those companies that has kind of set the stage for the last 3 quarters of performance. And so I kind of think Netflix this week is going to have a lot of eyes on it. Can it repeat its performance of the previous few quarters? Can it set the stage for how the rest of the market is going to handle earnings season? That's on my mind this week going into earnings, but also obviously Tesla. But the important names reporting this week, they're not the Apple, Google, Microsoft that week. It's not the big dog week. But Mark, you have leadership in every this week.
Man, I have a bigger watch list of companies than I've had. People say, I've heard people I respect and that I listen to that say this is the most important earnings season for the last 13 years. And once again, every year we've had a lot of that.
I've said that a few times, so I'm not gonna throw cold water on that,
But I do like my personal watch list of companies that I'm watching for reaction to, not that I don't even have any intention of trading, right? I have more banks this week because most of the time by this, I'm done with banks. I don't care. I mean, I got like Bank of New York Mellon, Western Alliance Bancorp. I have more companies that I'm watching this week in different industries than I have had. I cannot remember the last time. I'm very curious to see results, market reaction across a spectrum of places, right? Like it's
well, and specifically this week with the regional banks, Mark, you got Netflix, you got Tesla, you got leadership in every space. We got to focus on that. But if you recall, at no point in the last month were we worried about JP Morgan, right? Even though Jamie Dimon would like everybody to always be concerned about everything he does, nobody was concerned about the health and financial stability of JP Morgan. Nobody was concerned about Citibank. Nobody's concerned about Wells Fargo. And, Bank of America hasn't reported yet, Mark. They report this week. Nobody's going to be too concerned about Bank of America. Nobody's going to be too concerned about Goldman Sachs because it wasn't the institutional banks like Goldman Sachs. It wasn't the big money center banks like Wells Fargo, Bank of America, and Citibank. That was the concern in this SVB saga. It was specifically the regional banks out there. And we haven't seen the regional banks report earnings so far. Remember, the kickstop to earnings is the big banks. It's the Wells Fargos of the world, the BlackRocks of the world, the Citibanks of the world. And they all came through really, really, really good. You cannot throw cold water or any amount of shade on those banks and what they reported because their revenue handles were extremely, extremely good. But what about the regional banks? Because it was the regional banks that was the concern. SVB, a regional bank, Silicon Valley was a regional, Signature Bank regional. All the conversation about bank deposits were on the regional side of the equation. And this week, we get a lot of regional banks, U.S. Bank Corp. You get Fifth Third Bank. You get, our mom and dad. The first bank you and I ever started was Zions Bank. They come in this week as well. And so there's going to be a little bit more eyes on the regional banks this week, just because of how much they've been in the news recently with this SVB.
Yeah, no, it's going to be really interesting. And Matt, like coming into this week, like a lot of fewer economic reports, as we mentioned, right? I mean, we got a few, but it kind of lost in the shuffle. Unless they're dramatic, when you look at commodities, things driving gold, things driving Bitcoin, things driving oil, right? We have less data this week. What do you expect maybe out of gold this week? Red candle on Friday, but the unofficial VIX indicator Bitcoin
Didn't budge.
Dude, it came down to the 5 EMA on the daily chart and bounced to the penny, right? Like you want to know if there's any real fear in the market, right? That thing has told you for like 4 straight months if there was or not, right?
Well, my take on gold, Bitcoin, and kind of the little bit of the sell-off we had on Friday was most likely a little bit of an overshoot here, specifically on the dollar. You had retail sales come out, which was a terrible miss, came in far worse than the expectation. You can't say anything good around that retail sales report. And
it was terrible.
When you look at any economic report, when it comes out, there might be a convoluted, complex price response in the stock market, because who knows if it's a good news is bad news day or bad news is good news type day. Stock market could do some random crazy things every now and then. But in the currency market, it's a little bit more one-to-one response. You get a good economic report, that currency typically goes up. You get a negative economic report, that currency typically goes down. But when you're looking at Friday specifically, the dollar had a really good day on Friday, despite the fact that the retail sales number came in as a pretty significant miss. And you got to ask yourself that question of why? Why is the dollar going up so aggressively? Because it also saw that the central bank, at least the market participants, saw the central bank and see them as raising interest rates 1.25%.
Yeah, Waller was out there on Friday, higher for long. I mean, this Fed is hell-bent on keeping those T-shirts until they have to give them out. Like, it's like, we are inflation fighters until the end.
Yeah, we get it. You bought the T-shirt, you have the investment, we get it, we don't care, stop talking. We know whatever you do in 3 weeks from now is going to have to be given back. And if you do it, you're going to have to give it back sooner. That's the simple reality. And nobody in the market is buying anything the Fed is selling these days. Absolutely nobody. No, and what I mean by that is when you look at the CME Fed Watch tool, which kind of gives us the probability of what the Fed is going to do, Mark, they have a projection right now for the May meeting, coming up, and I believe it's May 3rd, at 83.4% right now. Now, a week ago, that was around 70%. And so you've had about 13 percentage points increase on the probability that the Fed is going to raise another 0.25. And most of that occurred on Friday. And so right now, the market is fully expecting the Fed to raise another 0.25. And when you look at whether the market buys whether or not the Fed is doing the right thing, you just go to 2 meetings from now, Mark, just 2 meetings from now, from May. So you go May 3rd, June 14th, and then you're talking about July 26th. And the market's expecting them to raise another 2.5 on May 3rd, but they're also expecting them to lower on June 26th. And so when we're talking about this being a nonsensical type move from the central bank, nobody around the world is buying what they're selling right now, because they're the boy who cried wolf. They're just up there nonstop, higher for longer.
The market, like, listen, what might have been a minuscule camp at one point is no longer. Is like, if you keep raising, you're going to keep breaking stuff, and then you're going to have no choice.
Broke something. It's time to stop.
Oh, Matt. That was just a flesh wound. That was just a flesh wound.
That flesh wound, okay, the Black Knight from Monty Python. Yeah, it's just a flesh wound. Right, your arm's off. Well, what's that then?
Worse, nothing 400 billion in liquidity can't solve overnight, right?
It got worse. It's called 08. And if you keep raising, you're going to cause consumer panic. And if you cause consumer panic, it's all bets are off.
Models don't show that. I worry, Matt. The only
models don't take into account consumer behaviors, Mark. That's
I know. I worry that this Fed, and this is the only thing, is short-term tactics, because I'm long bonds, long gold. It's just about, I worry about this Fed in the short term being so full of their model hubris that they feel like they don't have to, they're detached from reality.
They need to open source their models and stop just saying models, because I'm not sure they have a model right now.
It sounds good on a soundbite when they do.
True, but my general point on the gold move is basically just that. It discounted the retail sales and the economic factors while it basically focused on the interest rate adjustment. I think this gets resolved in the short term back to what was occurring before Friday, which means I fully expect Bitcoin to hold its pattern. I fully expect gold to hold its pattern, and I fully expect the euro to confirm its bull flag right now. And so I just think that was something we had to deal with on Friday. I don't, like I said last week, I don't think we should micro analyze the gold chart. I think this is more
and I'm trying to, because you are so consistent about this, about like, don't overtrade gold, which I would say don't. And I am a notorious overtrader, right? Like I'm trying to, like, how do I sneak in an aggressive covered call for a
well, and that's how I would handle it, Mark. It's not to
I am not getting out of my gold positions, hell or high. I'll lose money. I'm not over. I'm just, how do I sneak in some credit, right?
When in doubt, cover. That's the rule. When in doubt, cover. And so if you're a little bit concerned over the price movements, I'm not as of yet, Mark.
Well, it's more that we don't have a lot of economic reports this week or the next week. And so it's like, do I have a window to get in some covered calls, right? Like, it's just.
Well, I think you're probably over analyzing.
Oh, I guarantee I'm over analyzing.
I do think you're probably over analyzing, but that's a big red candle. There's no doubt. But Mark, when I look at GDX, for example, which is when we're talking gold, that's where a lot of people are, right? They're not everybody's looking at GLD or buying physical. A lot of people are doing, short-term trades, investments, covered calls, cash flow systems on Newmont Mining, Barrick Gold, your favorite silver stock, or GDX itself. When I'm looking at GDX here, we haven't broke the 9 yet. Even on that big down day on Friday, when we on gold coming back into 2K, GDX found the 9 EMA to the penny and pounded the buy right there immediately. And so I wouldn't be too concerned about what's happening in gold yet, especially when a lot of what we saw transpire on Friday was an algorithm move due to what the central bank was talking about.
100% agree. It's good advice. It's another reason I'm liking we're doing these podcasts on a Sunday, right? Like, I just like preparing for the week. I'm a scatterbrain during the week, right? I'm a scatterbrain during the week. I like to prepare early in the week and then just be on autopilot. Matt, are you ready to continue our conversation?
I am.
All right, let's do this. All right, this is going to be part 3 on our conversation on the history of the dollar. And where we left off, and I have found these so illuminating. And
I've enjoyed the conversations.
I've been waiting for the big finale, like I'm sure some of our listeners have been, because it's like, well, what do we do now? What do we do? Prepare for the future. But like laying that foundation of his history, and we picked up on the history from the gold standard last week. We talked about the euro coming into life in, what was it, 1999?
Well, initially in 92, but the public way in 99.
And then a fascinating take on the Iraq War, how a move away from the petrodollar set the stage when there were no chemical weapons in the ground.
Not that they found.
Right? But Iraq moved away from the petrodollar, who ironically in recent history, we'll talk about this in a minute, has moved away from the petrodollar.
Listen.
So why did we kill all those people, and why did we waste all those dollars, right? If they're just 20 years later.
Because you can bomb an entity, you can't bomb a movement.
And so we'll talk about some of the countries recently moved. And then we were talking, as we closed off last week, about the financial crisis. And this is where I would like to pick off, because I think it leads into recent developments over the last 15 years that have picked up in the last freaking seemingly. Man, I see more articles on the dollar in the last 3-4 weeks than I have seen in forever.
They're everywhere.
They're everywhere. I mean, talk about a timely podcast series when we started a few weeks, because they are just relentless right now, because
it's found our political conversation as well. It's all over the political environment as well, with what China and Russia are doing and the international response to that. And so it's been politicized a little bit. But to me, this conversation it goes beyond political parties. It goes.
Oh no, it has. I mean, whatever you think of Tucker Carlson, right? Tucker Carlson did a whole thing on the dollar, right? A couple of weeks ago, and then the last couple of weeks, right? Like, I mean, I've seen things start on both left and right ends of the spectrum talking about it. I mean, this is an issue that is coming into the the ethos. What did Tim used to say all the time?
Coming into the ethos. It is. It's all over. It's all over the financial news. It's all over the political news. It's taken on a story of its own, and it's. I'm the guy's like, okay, welcome to the party.
Yeah, listen, and I seriously listen. If you haven't listened to the last two, when you're listening to this podcast for whatever reason the first time, my brother Matt here that I am talking to right now, I think I am smarter than him on a lot of subjects in life.
He does.
I do.
This is true.
And I believe this. I sit in reverence at his feet when it comes to currency, and specifically the dollar, on his knowledge, his takes. I mean, he's a smart guy that's put in about 8,000 times more time than I have on it. So, Matt.
It's not an IQ level. It's a time in the seat. We've talked about that before.
Isn't that so true for life in so many things, right? So many things. All right, financial crisis. We left off last week, and you were talking about how this had an impact. The banking. Expand on this, lay the stage, and take the journey from there.
Again, you can't tell the story of the subprime meltdown without talking about the deregulation of the U.S. banking system for the 10 years that occurred before the subprime. But that's for a different podcast. You know me, Mark. I'm just, if I have a chance to take a shot at any politician for doing away with Glass-Steagall, I'm going to take that shot, because I thought it was a fundamental moment in our history. And so the subprime meltdown was a very, very important moment, not only for us Americans, as obviously when we talk about the upcoming recession, what do they think about? They think about that old subprime meltdown, that nasty, nasty subprime meltdown. Well, Mark, that nasty, nasty subprime meltdown was not just felt by us in the United States. When the U.S. economy fails, we not only fell our own citizens, we fail the world as well, because we're the leader in that. Our dollar is everywhere around the world. And like we talked about with the retail sales report, when a currency, and not a currency, but when an economy goes down, that currency goes down as well. And well, if you own that currency, you're going to feel that from an international trading perspective. And so the rest of the world went through this as well. And there was a movement that started very early on in 2009 that wanted to move away from the U.S. banking system, not just the dollar, but the United States banking system in general. And that's when you saw people create Bitcoin. That's why they kind of came in, was to not replace the dollar, but give an alternative to the fiat currency, faith-based currency systems of the U.S. banking system. You also saw in 2009 China make a strategic decision to start internationalizing their own currency as well. And so when people are getting up to speed in 2023 on what is happening with China, it really goes back to 2009, because China made a decision. Because who owns more debt than China? Who has more currencies than China outside of us? Nobody does. They're a massive trading partner to us. And they got hurt really, really bad economically there as well. And so they make this strategic decision to internationalize the Chinese yuan, is what they did.
I find this fascinating, because when you look at the heart of it, it makes so much sense. This wasn't some conspiracy. We hate the United States. This was like, we don't want to go through that again.
We would have done the same thing.
They're like, we do not want to be that vulnerable again.
Excuse me. Let me rephrase. We did do the same thing to the British pound and the US dollar coming out of World War I. We did the same thing. We're like, hey, we don't want to, and guess what? We did the same thing back in 1776 too. It just wasn't called the dollar. It was called the continental dollar. I mean, this goes back. This
is so fascinating. I mean, this is the kind of nugget here that you just don't get in the other articles and stuff, right? Like the origins, the whys,
Well, that's because the origin of this conversation is vitally important to understand what is happening right now. If all you look at it at right now, look at China and say, oh, China's signing another trade agreement. They're signing another trade agreement. No, there is an origin story here that if you understand the origin of something, you can understand where the future is as well. And when you're looking at 2000, China plays long-term games. They don't play short-term games ever. They play the 100-year war. They don't play the immediacy of satisfaction game that we in America like to play sometimes. When you're looking at that strategic decision, it's vital, Mark, because before 2009, China settled zero of their own trade in dollars. It was settled completely in euros, and US dollars. They didn't settle it in Chinese yuan.
Zero in their own currency. Everything else.
Everything else was euro and dollars. Everything else was euro and dollars. Russia, other countries, the BRICS. Now they might have settled in some non-US dollar transactions, but for the most part, a vast majority of all of this was settled in United States dollars. The US dollar is still today and was then the reserve of the world. But they made that strategic decision. And you got to fast forward just a little bit of time, and you got to go into 2013. And in 2013, China then starts the New Development Bank. And the New Development Bank was a charter signed between other BRIC countries. And so they went to the BRICS, Brazil, Russia, India, China, and South Africa. And they basically said, we want to create a competitor to the World Bank and the IMF. And the World Bank and the IMF are those financial entities that were created post-World War II that kind of set the traditional financial system for the world to participate in. And that's where the dollar is the reserve, and it still is. And so they wanted to create a competitor to the IMF and the World Bank. And then in 2014, another very important situation occurs when you also had China create the Asian investment, let me get this right, the Asian investment banking system called the AIIB. That bank was another competitor to what America and the European Union was doing through the IMF and the World Bank. They signed on 56 countries to use non-US dollar transactions in international trade, and they started testing the idea of utilizing a joint currency that was going to be created through a diversified currency called the NDV that would have the Chinese yuan, the Russian ruble, the South African rand, the Brazil. It would have Indian rupees. And it would be this diversified currency unit that would be a competitor to what the IMF does with the special drawing rights known as the SDR. That was really the first time we saw something on a large scale where you had countries that traditionally you would say were more pro-America, right? They do a lot of trade with America. They do a lot of investment with America. They don't economically, they're dependent on America, and they start moving away a little bit. But also in 2014, you have this interesting situation in Crimea happening with Russia. And up until 2014, Mark, people might not understand this, but Russia would settle 90% of their trade in dollars. They would settle that with China in dollars. But in response to the sanctions we put on Russia for their invasion into Crimea and the retaking of Crimea in 2014, Russia goes to China and basically make agreements over time to start moving away from the dollar. And the Chinese at the time are like, well, we kind of made this decision as well in 2009. But Mark, it's not one of those situations where you just make a decision and you just go do it, right? It's not like you make a decision to go invest in Apple and you just go click a button and it's done. We're talking about trillions and trillions and trillions of derivatives around the entire world, all denominated in dollars. And good luck getting through the international currency market without going through the World Bank and the IMF and utilizing SDRs. This is not a short-term conversation. This is, like I talked about with China, They're looking at the landscape 100 years from now, whereas sometimes I feel like we're looking at the landscape and what do we do in 10 days from now type environment. And so Russia finds a willing partner with China to start utilizing non-US dollar transactions. The problem is nobody wants the Chinese yuan, Mark, and nobody wants the Russian ruble. Like you can't just go to Brazil and be like, hey, I know nobody else settles anything in Chinese yuan, but hey, take Chinese yuan. You can't do that. And so they start doing it together. Russia and China start doing it together. And over the next 6 years, 90% of trade that is settled out of Russia and China is now basically 20% settled in US dollars. But what takes over is not the Russian ruble. It's not the Chinese yuan. It's the euro. The euro becomes the joint currency that is utilized in those trade agreements, Mark, because the euro is an extremely liquid currency owned by every country around the world, very similar to the United States dollar, and it has a very liquid bond market as well. You fast forward a little bit in time, you go into 2015, Mark, and this is when it all starts, and when this 2015 year is when it all kind of just clicked for me. Before 2015, for 3 straight years, Mark, I was on the road traveling, talking to awesome new traders, teaching them about the financial markets. And one of the segments I would always teach is a segment called, it was a currency segment, talking about reserve currencies and what is occurring. And I said for 3 straight years, Mark, that the Chinese wanted one thing and one thing alone, and everything they were doing from 2009 to 2012 to 2013 to 2014 was to do this one thing. They wanted to be injected at the big boy table of the currency conversation. And the big boy table of the currency conversation is the IMF. And the currency at the IMF is not a currency that we think about today. It is a currency that is held in reserve, that the value of the SDR is created through other currencies. And so they have other currencies that they basket together in prior to 2015. That was the dollar, that was the euro, that was the pound, that was the Japanese yen, that was those types of currencies. China wanted to be in the SDR, and understandably so, Mark. The SDR started off in 1969 as just an injection of liquidity during when the US was going to leave the gold standard. But by 2013, Chucky, there were 204 billion worth of SDR that was throughout the system. As of right now, that number's over 660 billion, Mark. They are putting more and more and more out there in SDRs, and China wanted to be at that big boy table. I was projecting for 3 years, Mark, from 2012 till October of 2015, that the IMF was going to make this decision. And everybody would tell me, you're crazy. The IMF is led by America. They would never do this. And I would say, you guys, I love America more than as much as anybody. I wear the red, white, and blue. I bleed it. I love America. I love our history. But we can't force our will on other people when China is going to these other countries and saying one simple thing: do you like cheap Chinese goods? And what do they all say?
Yes.
Yeah, we like cheap Chinese goods. Well, if you want to continue to enjoy the cheap Chinese goods produced by our cheap Chinese labor that you have created by exporting your labor to us for 35 consecutive years, well, you're going to have to use a different currency than the dollar. And Mark, if you're faced with that decision, what decision are you going to make?
Well, you're going to make, human beings tend to make decisions on practical measures, right? Like even in politics, right? Whether it is James Carville, it's the economy stupid, or Kellyanne Conway, that people vote, basically, they don't vote on their, emotion, they vote on their, wallet. They vote on practical reason, right? On their wallet. And so like a country is no different. Like, what is the practical decision that sets my country up better economically?
And let me ask you a question. Can you go get the same goods for the same cost from America?
No, you cannot.
Not even close. And so all of a sudden,
different goods, right?
Different goods, not the same goods, and certainly not the cheap Chinese goods. You can get better goods.
You get your iPhones, you get high tech stuff, right?
You get it all. So all of a sudden, China starts signing all these trade agreements to use non-US dollar transactions. And even though right now...
And so this started like long before the headlines that we've been seeing in recent months. This process has been underway for a while.
Long-term conversation. This is not a short-term conversation. It's not going to be a short-term conversation from this point out. Don't get me wrong. I fully respect the conversation that's occurring in our national, from a national perspective right now. And I'm very happy that more people are becoming educated about what is occurring from a reserve perspective, because it was really, quote unquote, conspiracy geeks like myself, or labeled thereof, that was on this, Chinese currency conversation over the last 10 years. And so it's good to see. But Mark, I've also seen a lot written in the last 2 weeks that are absolutely some of the most nonsensical hot takes I've ever heard in my life, that lack all historical context and understanding, and just wants to paint certain participants in this conversation as good and evil. When it's
let me share a couple of the maybe more reasonable hot takes, not the real crazy. A lot of conversation has been, because we have seen, you lay out the origins of this, 2009, accelerating of trade deals, all makes sense. And we've seen an acceleration of this in recent months, right? The Brazil deal, Malaysia. We've seen a lot of countries, but you would argue, rightfully so, that this is just a continuation of the last decade, right? This has been the trend, right? This has been the way the wind has been blowing.
Yeah.
Now, there has
that is my argument. It started in 2009. It did not start before 2009, and it escalated radically in 14 and 15, and it doesn't really change until post-pandemic, Mark. And so you get 2009 with the strategic decision out of China. You get the 2013 through 2015 years of the NDB, Russia and Crimea, and what happened with Russia and China out of that. The oil gold road to Russia and China, for example. And then in 2015, you ultimately have the IMF accepting within the SDR the Chinese yuan at the third largest currency being held there. And so the years of 2009 until the IMF allowed, because China actually applied for the SDR in 2010. They got denied, and they got denied by America. And America basically said in 2010, are you kidding, guys? Nobody uses your currency. Literally, that's what we said. Nobody uses your currency, and it's right. Nobody did. Not even the Chinese used their own currency. And so in 2010, when they got denied their introductory into the IMF SDR, China sets a warpath from a currency perspective and says, well, because the IMF only looks at the SDR allocation every 5 years, Mark. They don't look at it in 2013, 2017, 2018, 2019. They look at it every 5 years. Every 5 years from 1970 on, that's when they change allocation. And so in 2015, when they reapplied, all of a sudden they reapply, but instead of America saying, well, nobody uses your currency, all of a sudden now they go to the IMF and say, well, we have 56 trade agreements signed to use non-US dollar transactions in international trade. We've created the NDB and the AIIB as direct competitors. How far do you guys want us to go before you accept us to the big boy table? And at that point, faced with what China was doing, because you don't get introduced into the SDR without American approval, Mark. Yeah, it's a voting bloc, but that voting bloc is led by America, end of sentence. And in 2015, armed with all what China had done from 2010 to 2015, America basically says, all right, it's time to negotiate here. But unlike a lot of people who were looking at this negotiation and were familiar with this negotiation, Mark, I wasn't expecting the U.S. to take a back seat. I wasn't. Not at all. I think this is a negotiation happening here. And that's what my read at the time was. That's my read today. It was a negotiation. And when you look at the allocation of where the SDR was previously, the China getting injected into the SDR, you had 40% of the SDR was weighted in dollars, 38% was weighted in euros. Mark, we were coming through the European debt crisis where the pigs were just 200 to 1 GDP in debt. It was not my take that the euro was going to overtake at all. And basically what transpired was just that. The euro goes from 38 down to 30. The Japanese yen goes from 11 down to 8. The British go from 11 down to 8. What replaces it? Chinese yuan above 11. And so the Chinese yuan gets injected into the SDR. But unlike a lot of people who claim that the dollar's dying, the United States dollar actually came out of that negotiation with a higher allocation of 44%. That's what's happening here, in my estimation, is a very long conversation of the king, i.e. the dollar here for the last 80, 90, 100 years, giving up a little bit of its international allocation. And I do think ultimately the SDR, which is right now a basket of currencies that acts more like a bond, I do believe over time the IMF has plans to internationalize that currency.
Yeah, no. Any take on, because one of the more popular takes out there is that the sanctions on Russia have accelerated this whole process, right?
They have.
Like
that can't be argued. They have.
Like that, the heavy sanctions on Russia, which were very unprecedented as far as scale and as far as the scale of them. Basically, the take is to put in Mark common lingo, scared the hell out of countries that could happen to them. Right. And they didn't want to have that happen to them. Right?
Okay. I understand the argument on that. And I do agree with some of it and disagree with others of it. The part I agree on is sanctions absolutely did speed up this conversation. There's no, I think that is undeniable. I do not think you can argue that point. When you go back to 2014, Mark, and you look at what with Crimea and Russia and the sanctions that came on Russia, that's when Russia really said enough of the dollar. It was 2014. Up until 2014, over 90% of all trade out of Russia was settled in dollars. Today, that number is nothing, like hardly nothing, Mark. And so that was not the case just because of the Ukrainian war. It was also the case because of what was happening with Crimea back in 2014, that basically China found a willing partner to do all of this de-dollarization of the reserve system. And so sanctions played a role in 2014, and then sanctions in 2022 when the Ukrainian war became hot. Those sanctions just put this on steroids, and it just basically forced. Russia was already fully embracing it, obviously. China was lukewarm. They started internationalizing their currency, but again, they own a lot of dollars. India was an interesting partner in this conversation because they're probably one of the most important trade partners, if not outside of China, the most important trade partner for us in the region. They start doing it a little bit as well following that. So I don't think you can argue that sanctions didn't play a role in exasperating this situation from a reserve conversation perspective. There's no doubt in my mind that. But I also look at it and I say, okay, well, if sanctions did speed up this conversation, what were you going to do? Because you can't let Russian aggression just go unchecked. You can't do that. That goes against 100 years of American doctrine. You can't do that. And so I do think it's a little bit of a difficult rock and a hard place type conversation, but they did play a role in the expediting of this conversation.
Of something that was happening anyways, right?
But the issue, though, is what was the answer to those sanctions was a move away from the dollar, but it was not a move into the ruble, the Russian ruble. It was not a move into even the Chinese yuan. What Russia did was embrace the euro, is what they did. And so all of a sudden, yeah, you can bypass American sanctions, but you're not going to bypass the European sanctions, which are basically the exact same as the American sanctions. And so, yes, that played a role, but the response that they did in 14 was to embrace the euro. Now, what the response post-Ukrainian war, though, is they're now looking at embracing the Chinese yuan. And so, yes, it has absolutely played a role in speeding up the process of the de-dollarization of the reserve currency. But to what extent can it go? Because it is not my opinion in any capacity that the dollar dies at the end of this conversation. Like the dollar dies when America is not the first. It would take a lot, Mark.
It would take a lot.
It would take nuclear holocaust in our lifetime for that to occur. I don't see that happen.
And but before it, okay, let me sneak in some questions here before we get into ramifications. We've seen a growing list of BRICS countries, non-BRICS countries apply for BRICS application. We've seen Argentina, I mean, numerous countries like BRICS, Brazil, Russia, India, China, BRIC, right? Like we've seen this.
Welcome to the second Cold War.
You know, and so is this just an extension of what we're seeing in this larger conversation?
I absolutely think it is, Mark. I absolutely think it is. Go back to that 2015 agreement or the 2014 agreement with the BRICS, the Asian Investment Banking System, the New Development Bank, and those 56 trade agreements that were signed. A lot of those 56 trade agreements were the countries you're talking about right now. And so they were already in the conversation, but now they're taking it to another extent. And again, it goes back to the simple reality of what China is saying to a lot of these countries. If you want to enjoy cheap Chinese labor, cheap Chinese goods, you're going to have to play in a different financial conversation. You're going to have to play in a different game than what you've had been accustomed to with the Western alliance and the Western banking system that's dominated the global landscape, you know, post-World War II. And so, yes, it is absolutely part of the exact same conversation, Mark. Now, the ultimate question, though, is what percentage of these trade deals is settled directly in a currency not named the United States dollar? Because it's one thing for a country to sign an agreement with China to use non-US dollar transactions. It's a heck of a different thing if that results in 70% of their trade being settled in
and put in a simple fashion, if Argentina and China signed a deal between those two countries, but what is the trade between Brazil and Argentina?
That's and Mark, that's the difficult thing, right? Because right now, right
now it's dollars, right? Like
right now it's dollars, and even with Russia and what Russia and China does right now, it's still dollars, even though they're trying to move away from it. It's not an easy conversation to get rid of the dollar because
it's easy to go to China and say, yes, when we do deals with you, it's China, we'll do your currency.
And that's what has been going on, right? Is China goes to these countries and say, if you want to buy cheap Chinese goods, you have to come in Chinese yuan. If you know, Argentina wants to buy cheap Chinese labor, that's how they're going to do it, right? But if China wants to do some trade with Brazil that goes through South Africa, that gets settled through London, good luck getting away from the dollar on that one, because that's impossible, Mark.
Yeah, that seems like a 2033 question. Like it seems like if that happens, that's going to take time for the trust and faith of countries to develop, right?
It would take more than a Cold War for that to occur.
Yeah, so that is one of those pointing to the dollar's not quite dead yet.
There's a lot, and again, Mark, I say this as somebody who is very concerned about this conversation, who thinks it's one of the most important conversations we have. But I also think there's a lot that's made into the recent headlines over China signs X agreement with country. Because if China signs X agreement with country, that's fine. But if China signs X agreement with country that's also settling with this other country, all using non-US dollars, that's a different conversation.
That's a bigger headline.
Yeah, because that's when we go into the reserve conversation. That's the IMF conversation.
And we have not had that yet. Well,
no,
okay. in part 2 of this series, you talked about the petrodollar setting the stage for the, oh my goodness, we're moving away from the gold standard. Oh, petrodollar, let's replace it, right? Very key moment in the ascendance of true dominancy in the 70s and 80s and 90s for the dollar. There's been a lot of chatter, Matt, about a move away. Saudi Arabia, one of those countries, they have been playing friendly in the rhetoric with the United States in the last couple of years, applying for BRICS membership, I do believe. And there's been chatter about a move away from the petrodollar. Do you see that happening? Is it happening? Ramifications of that?
I personally do not consider the petrodollar a viable economic analysis at this point in 2023. 20 years ago, 90% of all oil was settled in US dollars. Now you got what, 50% of oil settled in dollars, and it's declining year over year over year over year over year over year. And it's been declining for 20 consecutive years, and it's going to continue to decline because there's other alternatives to the dollar out there. And we don't, again, think about the 70s, think about the 80s, think about the 90s. When we had the dominance of the petrodollar, Mark, it was a little bit due to 40 consecutive years of military activity over there as well. And there are certain things, without getting into too much historical weeds here and mud, there were certain things we could do in the 1970s, 80s, and 90s that you cannot get away with in 2023. Too much information goes around there. Too much happens. Too many people are in the know. And so you can't conduct the same type of foreign policy in the Middle East that was dominant in Kissinger's time, 70s and 80s, and specifically going into the 90s versus now. And so if this was 25 years ago and X country in the Middle East signs an agreement with another country to sell oil in non-US dollar transactions,
well, then we invade and bomb them.
I promise you, we have B-2 bombers flying overhead in no time. I promise you that. And that fear of the United States military bringing in hell onto their country, that fear would keep them in check. And it happened a couple times, no doubt about that. So there was a certain thing we could get away with that you can't do in 2023, right? And so things have just changed a little bit. And so for example, Saudi Arabia, one of our strongest allies in the region, who is basically controls the petrodollar, Mark, they are now selling oil to Europeans in euros, selling it to Russians in God knows what, maybe even gold. They're selling it to China in Chinese yuan. They're selling it to anybody they want in any currency out there, and we're not doing anything to enforce any form of trade policy. So I see this petrodollar conversation as one that constantly continues to go down from a dominance of a dollar perspective. It started out at 90% 25 years ago. Today we're south of 50. I'd be shocked if in 10 years we're not in the mid 30s% with a large percentage of that coming directly from us.
You know, now a lot of your analysis in the shifting currency landscape has pointed towards not the obliteration, not the end of the dollar, but less reliance. You know, percentage of dollars used.
Tell me, I'm not a radical.
You know, percentage of dollars used in transactions go down, whether it's the petrodollar or just in global transactions as a whole. You know, like currencies experience bear markets, just like stocks experience bear markets, just like commodities experience bear markets, right? Huh. You know, if is this declining use the type of thing that can create a bear market in the dollar, and what are the ramifications of that?
Well, purchasing power goes down over time. There's no doubt about that. So the actual value of the currency is going to be reflected against the economic value of other currencies. It's not going to be a direct reflection on these overall conversations. But what happens is the purchasing power, the actual BPE, the value of one unit of currency will certainly not go as far due to the devaluation of the currency over time. the conversation of
So for example, to give an example, in the 80s, the dollar was in a bear market, but the yen and the Deutschmark before the euro were in huge, like I said, at the turn of the century, dollar in a bear market, but the euro was so. I mean, something has to be going up.
That's how currencies behave, right? If one currency goes down, because
the dollar can't be in a bear market unless something's going up, and pretty good.
Well, that's the currency market, though, post gold standard. That's 1971 on. You have to peg currencies against something. And so if a currency just relies on its own value, there is no value to currency, because currency goes with the value of faith and confidence, of the economy, of the military, whatever the case might be. But there's no value to a currency, right? And so in terms of that currency, if you don't have utilization, the value is going to come down. But if the value comes down, that means one currency has to go up, because now that you don't have pegged currencies to commodities, what you now have is what's called freely floated currencies, meaning one currency is floated against the other currency. So if the dollar goes down, the net basket of other currencies go up. And if the dollar goes up, the net basket of the other currencies go down. That's why I say that's always a complicated question, because my analytical brain, I'm going to think about the price of that chart, and I'm thinking, well, that means that. But the actual impact on the buying power of the end consumer, regardless of the freely floated conversation, which is just a currency fluctuation, which means far more if you're traveling somewhere else than if you just sit in the US, as most US consumers do. The net value goes down regardless of whether the value goes up or down against the euro. The value in buying power constantly goes down. And so it's going to go down based, and again, as it deflates in value, that causes an impact to the downside, but that also causes an impact on inflation to the top side, which means whether it's inflation or disinflation, you still feel the net impact as the end consumer. Your dollar doesn't go as far. And then you wonder, whoa, wow, do you remember when we could buy a candy bar for this? Well, Mark, you and I grew up in the 80s, and I remember people complain about the cost of inflation. I don't care what generation you're in. They always do, right? Mm-hmm. And back in the day, I remember one of my only memories of our grandfather, Grandpa Nielsen, was, and he died in 1985. I was 7 years old at the time. And one of the only memories I have of him, outside of his jolly little chuckle he would have, he was a comedian a little bit, is he would complain about the value of a can of Coke. And I remember he would always say, you used to be able to buy this for 5 cents, right? And he was talking about way back in the day. Mark, we do that now with eggs 3 weeks ago, right?
Remember when you could buy eggs for $2 in February?
Yeah, we do that now, right? And again, some of that is just inflation. There's a component of that, though, that is the devaluation component that's also impacting that inflationary scale. Because as we lose our reserve status, this is the takeaway, Chucky. As we lose reserve status, the currency doesn't die. It doesn't cease to exist.
The British pound is still a viable currency 100 years later.
And so will the dollar. But what happens is you have trillions of dollars out there around the world economic system, stored at central banks, stored at corporations, stored at governments. And right now, that currency is sitting in bank accounts utilized in international trade. Well, as certain countries stop utilizing the dollar to the same extent, it's not like Argentina's not going to use dollars, Mark. They're just not going to use dollars with China. And that's lost in the headline a little bit, right? It's not like all of a sudden Argentina is going to be like, hey, if America wants to buy something from us, they need to invest in the Chinese yuan. That's not happening.
That's not going to happen.
Okay, but that's what a lot of people want to think is occurring. It's not. You're still going to use dollars. It's just that the percentages go down, but the fixed number of currency units that is in existence doesn't. It still has to be utilized. And so what happens in the utilization is all that money that's already distributed around the world through the banking system has to eventually find a home somewhere. And if less trade agreements are going to be conducted utilizing US dollars, we don't have to print more money to create more inflation. We just have to bring more of that money home to create a massive inflationary scale. One of the biggest concerns a lot of people has regarding the US dollar is if we lose reserve status completely, all this money is flooded home over time, and the valuation of the cost of goods and services. You think inflation's bad right now? You don't want to see what inflation is if the currency comes home. And that value would explode to the top side, while all of a sudden the supply of the dollar goes up exponentially, the value goes down exponentially. And so you get just double whammy approach of dollars coming home. Yeah, we have more money, but it's not even worth nearly as much. That's the ultimate concern when you lose reserve status. But Mark, when I go back to the British and when they lost reserve status, the British pound didn't die. It evolved. And when you're looking at a lot of what is conducted over the last 10 years, China is absolutely in process of internationalizing their currency. They are going to do this far more in the future than they've done in the past. How successful they
You can't stop this train. This train is
we created this train.
This train's on us. It's there's nothing you could do. I mean, there's nothing you can do, right?
Unless you're willing to go to war with China, there's nothing you can do. And how in the world can you make an argument to go to war with China if China wants to settle their own trade with any country around the world using their currency? How can we make that argument, really? I mean, really.
You accuse them of having weapons buried in the desert.
Well, we don't buy oil from them, so we don't got to worry about that one. But obviously, there's going to be a lot to be said about this moving into the future. Where we are at today is China is absolutely they have internationalized their currency. A majority of their own trade is now settled in renminbi, not US dollars, not euros. Russia and China are now settling cross international trade in their own currencies. The BRICS have signed trade agreements to use non-US dollar transactions in their own currencies. You basically have, how there's a lot of people that are talking about how countries are going to become a little bit more isolated coming out of the pandemic. Mm-hmm. Mark, from a reserve perspective, I think you're kind of going into zones around the world that certain currencies will take on a greater importance in that specific area. The euro in Europe, the Chinese yuan in the Asia zone, and then the US dollar throughout the world. Those are going to be the three competing currencies in this conversation. Ultimately, does one replace the dollar as the ultimate reserve currency? I do not. That's not my belief. That's not my way.
Matt, could you have, and I just barely thought of this, this wasn't on my prepared questions, could you not have a reserve currency in the world? Where you just, where it's like a European legislature where nobody has the majority and there's just factions of like 17% Green Party and 22% Labor Party, and
I don't think you could ever get that. There's too much competition amongst these big dog countries to be the dominant player in that, and that would go against 6,000 years of human history, in my estimation. So no, I do think reserves are here to stay. They've been around for 2,000 years. They're going to be around for another 2,000 years. But the question is ultimately not do we see the death of the reserve system, but are we in the process of the evolution of the reserve system? And specifically, are we in that moment of 2020 to 2044 where the dollar replaced the British pound? And everybody knew it for 20 years, but it took a massive World War II, massive anarchy throughout the world to bring everybody onto the same page. Because oftentimes, even in America, Mark, this is no different. We're a divided country right now, Mark. But if somebody punches us like they did on 9/11, we're going to get each other's backs really, really quickly. And that's
Americans are funny that way.
We are. We'll yell at each other, but we'll yell at each other. You yell at us, we'll get on each other.
If the space aliens come invade, we are gonna be there.
We're all gonna watch Independence Day, and we're gonna watch that terrific Pullman speech. You know, this is Independence Day. Yeah, we'd all do that, but
we will not go quietly.
No, we will not. No, we will not go quietly into the night. But the reality, Mark, is, to me, we're not looking at a situation where you're talking about the death of the dollar. And I know that gets headlines. And if I was the one getting up there screaming that, I'm sure I'd get more headlines. But that's not what this conversation is about. It's about understanding what is happening out there. And all of my research, because I don't think people understand when they talk about the death of the dollar, what that would mean to not the US economy, but the global economy. You're talking about a massive reset, and countries aren't going to do that. And so, to me, what I think in terms of ultimately what does transpire here is, I think when you actually read the tea leaves of not just what China is saying, not just what Russia is saying, but when you listen to India, when you listen to South Africa, when you listen to Brazil, when you listen to Canada, when you listen to France.
Macron, he's made a lot of headlines the last time.
Not just France, Mark. When you listen to London, when you listen to the Japanese, when you listen to some of the conversation that they have been having on this topic, they don't want to kill the dollar either. I think outside of Russia, I think Russia will kill the dollar at this point. But outside of that, I'm talking about, trade partners and whatnot. I think what they're all working towards is a diverse currency system from a reserve perspective, where one currency isn't the dominant transaction that settles everything in that one transaction. Again, reserves are currencies that are held by other countries to conduct international trade. It is not, if you want to buy Chinese goods, you need to buy it with Chinese yuan. It's if all the other countries purchase, if Brazil purchases from Canada using Chinese yuan, that's a reserve conversation. China going out and settling their own trade, that's China's sovereign right, quite frankly. And so when you're looking at this from a reserve perspective, I do believe it's the SDR created in 1969, allocated for the first time in 1970, injected another liquidity in 78 through 82, has increased exponentially over the last 20 years. And it was China's stated goal to get into the SDR for 5 consecutive years. It is, in my estimation, the SDR that could become an international reserve currency that you and I would never use. We would never use. We're talking reserves that are done through the banking system, the central banks, and when country A wants to buy goods from country B, what currency is the settled currency? I do believe the SDR, which can be converted from the bond it is right now to more of a currency, that could be one to replace the actual dollar. And when you look at the allocation of the dollar within the SDR over the last 10 years of this conversation, the United States has actually increased its allocation within the SDR, not decreased it. Who has decreased it? The Japanese, the Europeans, and the British. That's who's had to give up some to welcome China to the big boy club of the SDR. Now, what happened with that allocation in 2020? Well, it stayed the same for the dollar, slightly increased for the yen, for the yuan, slight gave up a little bit on the euro again. And so the ultimate question is, what if there is something to replace the dollar? What is that something? And to me, Mark, this is not a 5-year conversation. This is not a 10-year conversation. This is a 20 to 30-year conversation. From a currency perspective, you're talking a 50-year conversation. But to me, it's not it's not a single currency that will replace the dollar. I do not believe that. China cannot the Chinese yuan cannot replace the dollar without going to World War III, and that's not happening right now. And so to me, it's not a single currency that we need to talk about. It's what system that the decision makers at the highest levels want. And when you look at it from that purview, they want a diverse currency system that is not reliant on the economic value of one single currency.
All right. Final question, Adam. We see some trends in motion, right? Right. You've painted a really good picture of not only the history, the trends in motion from an investing perspective, right? You obviously are not claiming for the end of the world. Anyone that knows my brother should know that that wasn't going to happen.
That wasn't going to happen.
But, there are, investing ramifications from, these mega trends. While slow, they are in motion, right? They are in motion. What are some of the investing ramifications?
Well, I mean, that
on gold.
The number one takeaway you have whenever you go through this conversation is you own gold. There's no doubt about that. That is the number one takeaway from all of this, is diversify your holdings from a currency perspective. If you know the world is moving away, and by the way, Mark, the U.S. is not exactly putting up a massive fight over the last 20 years on this conversation, Chucky. And so the U.S. kind of sees—
Is that strategic or hubris?
Well, that's a complicated answer. My philosophy is that at the decision maker table, it's strategic. I do think so, because being the reserve currency isn't necessarily all it's made up to be. It does force you to go into a tremendous amount of debt over time as well. And so there is some conversation out there that maybe being the reserve is not all it's cracked up to be. To me, I do think the writing is on the wall. I do think we're moving to a diverse currency system. And if that's the case, then we want to diversify our currency holdings as well, and not just participate in dollars, but also look at other types of currencies out there. Look at, for example, gold. Gold has been a currency for 6,000 years, Mark.
Along these lines, because central banks have been buying gold nonstop, right? They've been buying, like teenagers were buying Bitcoin in 2021 when it was ripping. They've been loading up on gold. Are they just preparing for this transition in case there's hiccups, in case there's fluctuations?
No, I think they're going to have gold allocated within the next system. And so when you look back to the 1930s, Mark, history, an understanding of history really helps you understand current actions as well. When you go back to the 1930s, before the gold standard was created in the 1940s, to create a fundamental currency system, you have to have something to back it. Well, that something to back it in 1944 was gold. Well, how does the U.S. for the 20 years, since we knew for 20 years we were going to become the reserve, that writing was happening.
They confiscated all the gold. Holy cow, that's what they did. They confiscated all of the gold. It was illegal to own gold during that time.
In 1933, they outlawed.
How did I just put two and two together there? That's
in 1933, they outlawed personal gold ownership and basically made it illegal to own gold. And they basically said, if you come deliver your gold to us, we'll give you $20 an ounce. By 1944, they pegged it to $35 an ounce. It was the greatest trade that the American government had ever done. It just so happened to rip off the American people. But
they were doing that to establish the base for their currency.
To establish the base for
that's what central banks are doing right now.
Yes, they are. Yes, they are.
That is what they're doing, because you see the numbers. They're hoarding up on gold. They're loading up. They're buying. And when that happens,
Mark, I was really convinced on the Chinese yuan being injected in 2015 to the point where I was adamant about this was happening. And Mark,
you're just early.
I was just that was a couple of years early, but I was adamant in 15, and they did do it in 15. I'm pretty certain gold's going to play a role in the next reserve.
That makes sense.
And it's not going to be led by America. that conversation is being led by the Europeans, the Russians, and the Chinese.
That is why they're loading up on gold. That's why they're loading up on gold. Makes perfect sense, right?
So we should do the same thing.
Yeah, that makes sense. That just makes so
Take
much. Dirty government confiscating gold from a citizen.
That's an interesting story. Yeah. Well, Chuck, that's the currency story, and
that's a good story, bro. Okay, I'm not going to be as aggressive covering my.
You're like, to the moon.
No, you want to own gold, right? You want to own gold.
Listen,
right?
and it's just a great way to diversify. If they're going to peg, great. If they're going to use it, great. We just know they're hoarding, and we know there's historical examples of them doing the same. So again, I said this 3 weeks ago, Mark, the takeaway you're going to have at the end of this conversation is you're going to want to own gold. And I do believe that is the takeaway.
That's a great story. Like you Matt, I like to, on behalf of everyone that listens to this today and the future, because this podcast is going to have some of that timeless value where, it's applicable to understanding. And listen, we'll break out the money series part 2 when Argentina and Brazil decide to trade within the yuan with one another. Then
now, if that occurs, I have a different conversation for that.
If we ever see that happen, then we will be back with a
part 4, guys. Conversations change. We got to, but no, I appreciated the conversation. It's a topic I do care about, and I hope. I'm not looking for everybody to agree with me on these conversations, Mark, because I don't know everything about these conversations. They're reading of the tea leaves, and somebody might have a different takeaway than me. But I do think the conclusion is always the same. At the end of the day, whether you're calling for the death of the dollar or what I'm calling for a slow bleed down to mid 40% in utilization, they both result in trillions of dollars coming home. They both result in the value of the actual currency going down. They both result in higher cost of goods and services.
Well, they point not just gold to owning real assets.
It's right. Not just gold. It's getting your currency working instead of sitting there in a bank account.
Real assets grow. I mean, yeah. Real assets.
All right, send us out, brother.
Good story. Listen, earnings season gonna be. Listen, check us out in the halftime report. Matt does a great job providing breakdown of earnings. I've made some good calls, good shots lately. Right, halftime report.
Great.
You don't want to miss it. You're gonna make money. You're gonna make money.
You gotta make some money.
So listen to the halftime report. It makes you money. But we'll be back next week. Take care, everyone.
Thanks, everybody.